Hello, everyone. I've got some amazing stock market statistics of the week. And one of the reasons that they are so enthralling and eye catching is because it's coming up to the end of the year. So everybody is looking at the year just gone by, and that's giving us even more great things to share with you. So let me share those straight away with you. And what you'll find in this short broadcast is we're going to go through everything from cryptocurrencies to individual stocks, to the market projections of some of the biggest banks out there. So first things first, let's go on to the very first one of those. And those are the big banks, and those are their projections for 2022 and the S&P 500. Now, Wells Fargo is, in one sense, the outlier. I should say my former assistant is now global head of communications at Wells Fargo, so I'm gonna root for them. Go Susan. Morgan Stanley is the outlier to the downside. You might think, hang on, don't most of these people go to the same universities and sort of work for each other in their careers? How can you get one extreme example having a view at one end and another one at the other? And should we just average it? Well, to be honest, I tend to ignore most of these forecasts. For me, it's really about the fact that I'm going to be picking relatively undervalued companies. In other words, companies whose share prices are good relative to their earnings. Revenue growth, so I want valuation, revenue growth, earnings growth, cash flow and cash flow growth, dividend yields, consistent outperformance of the markets, all of those things that actually you'd want in companies that you like. So that's the first thing I want to share with you. The next one, yes, we've got a whole load of stocks like this. And I guess in one sense, what these headlines are telling me is it's not really about what the broader market's going to do. It's really about the individual stocks we're going to be picking within those to get the outperformance. And we don't need to bet on the whole market, although I do still have my triple leverage S&P 500 exchange traded product. So triple leverage, yeah, that's high risk, massive risk warning. And in case it's news to you, all investing is risky. It's not a bank account. Okay, so what about Goldman Sachs's view on the markets for next year? Well, they're bullish again, and as you'd expect them to be, they're bullish again. And you can see the numbers over there for 2022 and 2023 and the index levels. Of course, nobody's going to say we're going to get the kind of year we just had. Nobody would have the gall to say it. And with GDP projected at being some of the best levels, or economic growth basically, since the best levels since the Second World War, you certainly wouldn't think they're going to say there's going to be a fall in the collective valuation of the largest companies either. So that's where we are. Well, what does a typical year look like anyway? And you can see there, and you might want to pause the video. You can see there that in actual fact, you do get quite a few good years. Okay. And given the number of very good years you do tend to get out there, the odds are in your favor anyway. You're going to get a 10 to 20% year. And years like the year that's just gone by, where you got 20 to 30%, yes, they're outliers. For me, the real issue is, are the banks right and we get 10 to 20%, or are we going to get a blowout year and get 30 to 40% just as the market has one last crazy blowout? Like I said, I'm not going to try and forecast the broader market. What I'm going to say is that my stocks will benefit if the market does decide to rally upwards, and should fears of inflation and COVID and everything else lead us to the left-hand side of this graph, well, my stocks will be the type which won't fall as far and will indeed protect us from those falls. Okay. This was an interesting thing I came across relating to the average holding period of shares held on the New York Stock Exchange, and that period has dropped, as you can see. It's gone down to about a year. Well, I've been saying that for a heck of a long period of time, that on the whole, we're looking to hold companies for a year. And one of the reasons is, well, shorter company lifespans, but also everything's been compressed thanks to technology, in terms of the profitability of companies happens sooner, the market cap of companies grows that much quicker. So this whole notion, you might hear journalists say it as they write their articles and try and fill their word counts. Oh, you've got to find some good stocks to buy and hold forever. Forget it. Forget that. Okay? Because it isn't about buying and holding forever. It was about buying and holding forever. Where were they when COVID happened? Did they see that coming? Could they see through that. And you might say, oh, no, the kind of companies they're talking about could go through everything. You're right, they should be able to go through everything. So why not just review them every 12 months and see, are they still fit for purpose? Are they still hitting those revenue growth numbers, cash flow growth numbers, valuation figures, consistent outperformance, and so on. So I really like that image because it fits into what I believe anyway. We always like those kind of things, don't we? Concentration of market cap in the largest stocks has soared. In other words, the market cap of the 5 largest companies as a share of the S&P 500, the 500 companies in the US, the 500 largest companies, well, it's soared. In other words, the big are getting bigger and they're soaking up more of the returns. To me, it's also a flight to safety. And I think if the markets were to fall back, this concentration level will increase even more because people will fly to those bigger market cap, lower volatility companies as well for security. Now, you might read this differently. You might say, no, hang on. Isn't this saying in another way that we're due for a crash? I think that's reading a bit too much into it. Concentration of wealth or concentration of gains in ever decreased number of companies can be an indicator, not a broad rally, and therefore doesn't have legs. However, I think that's reading a bit too much into that data from Goldman Sachs there, if we were to make that conclusion. This is year-to-date performance for the S&P and the NASDAQ. As you can see, all pretty much the same, 22 to 26% return for the year. That's pretty good, isn't it? Now, I target 40%. Obviously, in a year where the market itself is going up by about mid-20s, it's a hell of a lot easier to hit your 40% return. But the real question that I want you to ask yourself is this, and ask your IFA, ask your journalist, whoever you follow, ask your fund manager, how come your pension isn't up 25% this year? After all, if all you've got to do is sit on a beach and track an index, how come it's not up? Or in my case, because I triple leverage the S&P 500, roughly up 75% on that instrument. Okay, but your pension as a whole, why is it not up 25% when those guys keep charging you fees, whether it goes up or down? And you'll find some worrying answers to that, I'm afraid. Okay, what we're also seeing going forward, and this is data from Bloomberg, and this will happen in 2022 more and more, is the S&P 500, the major markets, will have more back-to-back losing days. In the past, it was infrequent to have a big losing day and then the next day to be a losing day. It would normally be buy the dip, market goes up. Now we're getting a few more consecutive losing days, and that can trigger more caution, more concern, more fear in the market. I'm not saying we've peaked, although as I speak to you, we're at all-time highs, but what I'm saying is you're going to get more of those volatilities and more of those down periods. So in one sense, I've told you, don't panic. Keep that perspective. Really enjoyed this one. Percentage of world stock market cap by country. So America represents almost 44% of world stock market valuations. Okay. And COVID hasn't done them too bad. China is next up with about a quarter of what America's got. Japan is half as much as China and 1/8 of what America's got, similar to Hong Kong. Hong Kong's going to be going downwards given the Chinese lockdown. And the UK and India and France are pretty much similar in terms of market capitalization of their stock markets. Again, take a pause. It's an interesting thing to read and look at, I think. For those of you interested in such things, these are the top 10 growing cryptocurrencies in 2021. Did you have any of them? I'd be interested to know. And that's how they fared. Again, pause the video if you wish, and you will then be able to see, yep, none of them went up in a smooth diagonal line. I guess the greatest was Polkadot or Chainlink, or maybe even Cardano, were closest to a diagonal line. The rest were slightly more of a roller coaster ride. I'm not going to say any more on those. Not really much more for me to add onto those. But what I will say is have a very good Christmas and prosperous new year. Have a look at my campaignforamillion.com, campaignforamillion.com, where I've got more free resources, and you'll find my Telegram channel and debt-free downloads of my books on there as well. So with nothing else to say, Happy New Year.